Hello, chart watchers, and welcome to this Thursday, November 29th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, one day after a huge market move on the Fed speech, we've got the Dow Jones Industrial Average currently down 77 points, the S&P 500 down 7 and change, the NASDAQ down 27, and the Russell 2000 down 4. 10-year Treasury yield gap down pretty significantly this morning, currently down about 2 basis points, 3.03%. Volatility index back on the rise today, breaking the recent downtrend that we saw. Volatility index up about 4% today, back above 19. XLE leading the charge to the upside, up about 2/3%. Also having a pretty good day. Materials. To the downside, we've got financials, which are down about 1% so far today. Technology also down about 1%. A couple of industry groups leading to the upside today. We've got the toys bouncing just a little bit more than 1%, and tobacco up more than 1% as well. All right, Aaron, one more day till the end of November. Great show yesterday with Mark Chaikin. We had a beautiful market move yesterday after the Fed, and now today it's like
yes. I know. I wrote about it yesterday that basically I thought it was a relief rally. And, well, you'll see in the schedule, I'm going to be talking about making a case for a bear market. So stay tuned for that one. But I do have big news, Tom.
Okay.
And that is that it is raining in Southern California.
Wow.
I know. It is true. I know we had that strange rally yesterday, and now... wow, I got rain. So anyway, it's a good thing for Californians, and I know it's up in Northern California as well. So hopefully we won't see any mudslides, and we'll just get rid of all of those fire hotspots that are around, but we'll see.
Yeah, maybe it was that huge move in the market just kind of shook things up and got the rain going in Southern California.
Exactly.
Why not? I mean,
why not?
The market gets blamed for a lot of things. We'll just give it credit for the rain.
There you go. Yeah, it's nice to get credit for something, I guess, huh?
Yep. All right, we got a busy day ahead. So what do we got going?
Yes, we do, and the week is not over yet either. So tomorrow, I know we have What's Hot and What's Not with Mary Ellen. She will also be co-hosting tomorrow. I will have my workshop on Tuesday. I'm still thinking about it, but I'm thinking I might go the beginner route. I might just do something for beginners. Gaddis is going to be with us on Wednesday of next week. So great week shaping up. Let's see what we're going to do today, though. Well, we are going to start off. I know you have a December seasonality report, Tom, so we'll see what you're seeing for next month or this coming month. 10 and 10 to 1. Our first symbol is going to be EverTech, EVTC, if you want to go take a peek at that chart before Tom does. And then I'm going to finish off the show today with a case for a bear market. So stick around for that. Like I said, I've got some interesting information for y'all. All right, Tom, technical news and headlines.
All right. Well, there was some pretty good technical news out there today, quite a bit of it, actually. And we'll start with initial jobless claims. I believe last week we had a pretty big miss, disappointing number with the initial jobless claims coming in much higher than expected. And we did it again, 234,000 versus 220,000 expected. October personal income rose a bit more than expected, though, 0.5% versus 0.4. October personal spending rose quite a bit more than expected, 0.6 versus 0.4. And then another very disappointing report out of the home construction space and home building. October pending home sales fell 2.6%. Market was expecting a flat number. And yet I know the last time I looked, home building was actually holding up pretty well, trying to move higher. So I think that still kind of fits into that theory that a lot of bad news has already been built into these home building stocks. And I believe they bottomed. And you look at the 2018 market, for the most part going higher while home builders been going down. Even if you think we're in a bear market or even, just in a correction sideways mode, we could see outperformance from home construction stocks for a while just because they were so oversold. Don't forget, 2 o'clock this afternoon, FOMC minutes come out. I think there will be a lot of traders looking at the language there to see if it kind of, I don't know, kind of goes hand in hand with what Fed Chair Jerome Powell talked about yesterday at noon Eastern. And that was really what sparked the market yesterday. We had Mark Chaikin on the show, and literally as soon as that announcement came out, the market took off and really never looked back in the afternoon. I tend to agree at this point with Aaron. I think that a lot of it was an oversold bounce, relief rally. I'm not convinced that it's going to stick, but we shall see. We are heading into a historical bullish month. I'll talk about that more in a bit. All right, let's take a look first, though, after the economic reports at the 10-year Treasury yield. You can see that we gapped down today, and we did hit 3.008%, so roughly 3.01%. That was the earlier highs. Talked about maybe going back down there and retesting. We have now done that. I think a move below 3% would kind of be a check mark in the bear column. I think we want to really watch this 10-year Treasury yield, because if the market believes that the economy is going to continue to expand, we should see money rotating away from Treasuries, which would drive the yield higher. This is what we've been seeing here really since early October, is the exact opposite. We've been actually moving lower in the yield, which means money is rotating into Treasuries. And that is normally done when you expect a slowdown in economic activity, not an increase in economic activity. So this is going to be an interesting area to watch, I think, in the near term. I wouldn't necessarily say we're in a bear market if we go below 3% on the 10-year Treasury yield, but it would be another one of those check marks. I think it's worth watching. All right, let's move into the earnings news. We did have a few earnings reports out last night and this morning. One big one that I was watching was Viva Systems, because they had reported such a strong report the last time around. And they did come out, they beat on the top line, they beat on the bottom line, they raised their revenue and earnings guidance. We'll look at the chart in a minute. But that was a pretty good report. Toronto Dominion Bank beat on the top line, beat on the bottom line, as you can see there. Canadian Imperial Bank, though, even though it beat on the bottom line, fell about 3% short on its revenues. Dollar Tree, well, it looks good on the surface there, but they missed on their revenues. They lowered their Q4 revenue and earnings per share guidance. Stock really getting hit today. We'll look at that chart again in just a couple minutes. And there you can see quite a few stocks, key stocks in the technology area reporting after the bell tonight. So you want to keep an eye on that as well. All right, so let's take a look at some of these earnings reports and the charts. The first one will be VEEV. And on VEEV, it's a lot of indecision going on in the chart today. You can see we essentially opened right where we closed yesterday. We had a really strong day with the market yesterday. A lot of anticipation maybe for another strong report here. And it was strong. It wasn't as big a beat as we saw in the last quarter. And maybe that was a little disappointing to the market. But when you beat on the top line, beat on the bottom line, and raise your next quarter's revenue and earnings per share guidance, I don't know how much more you can do. And yet the stock's only up 46 cents today. But look at these long tails. The low today was at 94. The high was at 101. Market is trying to figure out what to do here. And I think the report's good, but I think the market traders are still very nervous about the overall market. And I think that is holding back a stock like Viva Systems, which did post another solid quarter. Next up, Toronto Dominion Bank, TD. And here you can see gap up, but failure so far. Question for me is whether or not we hold the 20-day. I suspect we will. We got a positive divergence here on the chart, higher PPO with lower price, went through the 20-day moving average on increasing volume. I would expect us to hold the 20 and make a move back up toward maybe 56.25 to challenge the earlier high in November, and maybe hit this declining 50-day moving average, which is now below $57. So somewhere, maybe another $1.50 higher is where I would expect perhaps a bigger test for TD. Let's take a look at CM. This is Canadian Imperial Bank. They missed, as I mentioned, on the revenues. They did have a slight beat on the bottom line. This could be a double bottom going in. I'd be okay. I mean, if somebody really looked at the chart and said, hey, I want to buy it here, I'd be okay with that. But just notice we've already put in a lower low than we had a little over a week ago. I think if I was trading it, I'd keep a really tight stop here. I would not want to be involved in the stock if it does make another breakdown. The good news is that it does have a positive divergence in play. So I think a false breakdown could potentially lead the stock on a surge, maybe back up into the 88 area. That would be a test of recent highs and also a test of this declining 50-day moving average. For those of you maybe not too familiar with how I track the PPO and these divergences, when I see a downtrend like this and the PPO is declining, I look for bounces to the 20-period moving average to fail. Once I get a positive divergence in play, though, higher PPO with a lower price, that's when I start to think that perhaps we could make a run for the 50-day moving average instead of the 20 and see if that PPO can maybe get back up and reset at that 0 line. So those are just some of the ways that I look at the PPO and the price action and these various divergences. But if we can, go back down, test that low and hold, I think in the short term, CM could be okay. Now let's take a look at Dollar Tree. This is a mess. Actually, this is not the one I'm sorry. Tilly's is the one that was the mess. I'll show you that one in just a minute. But Dollar Tree did lower their guidance. Actually, this is the one I was looking at earlier. I think the way this is performing could be signaling a bottom. I'm going to go a little bit longer term because we've been downtrending for a while. And when you get bad news like this and you get a 5% rally on it, that to me suggests that perhaps we could be seeing a bottom. So yeah, here was the downtrend. The stock was up 117.50. You can see multiple bottoms around 80, maybe 79 to 80. So the stock had been downtrending, comes out with bad news with earnings, and then moves higher. Maybe we get another pullback, but I would say that 79.80 support level now is probably pretty strong. But let's take a look at Tilly's because this was the one that had reported great numbers back in August and September, if you remember. I traded it unsuccessfully on a couple of times. I really thought when it came back down, I think I might have tried the 20-day. I know I tried gap support right in here. I thought I was a hero there for a short period of time, but quickly market moved back against me. The stock moved against me. We went back and closed. Intraday moved back below those lows that we saw in mid-September. I thought gap support would hold. Instead, it's continued moving down, and now we know why. Tilly's came out. They missed on their top line, beat bottom line by 1 penny, but then lowered their Q4 earnings per share guidance. And if we take a look at the relative chart on Tilly's, you will see that in addition to the retail group moving up and putting in a higher high, you can see that prior high on Tilly's occurred back in September. And as the entire group was breaking out to new highs, we had already seen a lot of relative weakness. And I was giving the stock some room for a while and a little latitude, making some excuses for it. But after it continues moving lower and breaks down like this, and look at the relative strength after making such a huge move to the upside, it was trading not too far from a 52-week relative low before the earnings came out. And now we're certainly down there at that level. So again, this is one that was trading down into earnings. And it's another example of why many stocks I don't believe are good long-term buy and holds. June, beautiful move up, sideways consolidation, another beautiful move up. And now here we are 3 months later, and all of those gains erased. Anyhow, Aaron, I know you got a number of upgrades, downgrades. What do you got for today?
All right, let's go take a look. All right, I'm going to start with our upgrades. The first one is going to be BJ's Restaurant. BJ's was upgraded today by Loop Capital from a hold to a buy. I went ahead and looked at a couple of the support levels and resistance levels. If you look in the thumbnail, we got a nice big move, maybe off of this upgrade to that $60 range where it stopped. And you can see where that lines up with previous lows here, forming some pretty strong resistance, I would say, and it did hold. And now we're trading all the way back down here at 55. So I would just be aware of this level of support, very short term right here. You could go ahead and, if you wanted to try and get a play here, you could. I wouldn't, just because I am pretty much married not only to my husband, John, but to the PMO. And the PMO is just not looking healthy enough, in my opinion. I wouldn't want to get into it just yet. But if you're a short-term trader, maybe you want to give it a try to see if it'll get back up to that $60 range. All right, next one, McDonald's. Hopefully you're hungry. A couple of restaurants here. All right, McDonald's, I decided to pull out into a longer-term daily chart, mainly because I was looking at this +3 level of the PMO. And, I noticed that we had +3 and -3 on the annual chart, the 1-year chart. So I thought, well, maybe that is the range for the PMO. Well, no, it really isn't. When you pull the PMO out about, let's see how many, 5 years here, the real range is between 2 and -2. You can see typically that's where you go. There are moments where we get very overbought. The last 2 times, because I was looking at that, well, is that bad news? Not really. When we've had these overbought readings, we have come at the beginning of a move to the upside. Of course, it does usually bring the move to the downside when you get those sell signals in the shorter term. But over time, it looks like really with McDonald's, it's not horrible to see this. And as you know, as you can see in the thumbnail, we've come down, we got the sell signal. It's still technically on a sell signal, but with this gap up to looks like all-time highs, you've got PMO getting ready to make another buy signal, but it is in overbought territory. The stock is overbought.
Aaron, I'd be interested to see what that looks like on the weekly chart, looking at your PMO.
Absolutely.
The daily came down, but I bet the weekly stayed strong.
Absolutely. Let's take a peek. Yeah. See, the PMO is looking pretty good. And you can see that back in those 5 years, those times where we had that overbought PMO on the daily chart, not too bad here for the weekly chart. The main thing is notice that it has been fluctuating above the 0 line. And that tells you that in general, you've got some, some internal strength going on there. So, if you want to look at it as a more intermediate term, certainly you could do that and follow the weekly PMO. All right. Rider System was upgraded by Stifel from a hold to a buy. I picked this chart to look at because I think this might be one of those maybe momentum sleepers, or one that's just getting ready to hit a turning point. And I say that because you have this buy signal that came in on the PMO, and it came in not at the best time because obviously we ended up seeing the price move down again. But then we had that, what I call a bull kiss. It came down, kissed that signal line, and it started back up on this rally. It's still very much oversold. You can just see that right here from the PMO. I think this one has an opportunity to build. You can see the scooters trying to turn back up. Watch volume. OBV isn't all that impressive right now. But if we can get above that 57.50 level, I think this one could be very interesting. Rider System R. All right, a couple of other upgrades that I'm not going to go over. Dominion Energy, D, TJX companies, TJ Maxx, TJX, that was also upgraded today. Cracker Barrel, which interestingly was downgraded yesterday, was upgraded today. So if you want to go take a look at that, Cracker Barrel is CBRL, and PPG Industries also had an upgrade. All right, let's come back here. All right, sorry about that. Okay, so let's go ahead and look at the next one up. Okay, what happened here? There we go. Okay. All right, so a couple of downgrades, and I'm going to just go through really quickly because I know I'm low on time here. Tom, I want you to get started. Okay, so we had the breakout, but it failed, and we're now back down on American Express. The PMO still looks pretty healthy here, but I don't like that breakout that failed. And now we're coming down and trading near that low here. 110 could be a good support area in the very short term, but if it fails to hold that, this is a downgrade. While the PMO looks pretty good, I would just be a little bit, pay attention, use some caution. Intel was downgraded today. Intel was downgraded by DZ Bank from a buy to a hold. I think we've looked at this chart quite a bit, but at this point, we're in that trading zone right in the middle of it. I wouldn't really do anything with this one until I saw a breakout at 49 or holding support here at about 46.50, because then I would look for it to come back up in that trading range. And the last one, Constellation Brands, also downgraded. And we can see PMO is about ready to give us a buy signal. So I liked this chart, but you can see that we popped up, we broke out above this area here where that resistance, where we had the low back here in August, and then we failed and we've come back down. But we're still holding this short-term support level right here at 195. So it might be an interesting short-term play, tighten that stop. But I think you get that buy signal to come on through, and I would expect some good things here out of Constellation Brands despite the downgrade. A couple other big name downgrades: Dick's Sporting Good, DKS, Allison Transmission, ALSN, Chico's, CHS, First Financial Bank was also downgraded, and Columbia Sportswear, COLM. All right, Tom. Seasonality. I'm very interested to see what you have to say. And I know that you have a poll question up there too, a little quiz for everybody. So go ahead and take that.
Yeah. All right, let's get into the seasonality. First, I just have a chart here up of the S&P 500 that you can take a look at. You know, the S&P, as you can see, is definitely strengthened as we head into December. We've gotten through the 20-day moving average. We've only done that since all this selling began in October. The only other time we've done that was back earlier in November. And of course, that failed. We came back down. We did not bounce off that 20-day moving average. We went right back down through it. So one of the short-term technical things I want to look for is whether we bounce off that rising 20-day moving average when we pull back, because we are in a very bullish seasonal period right now from November 22nd through December 6th. And the whole month of December actually is a very bullish month for the S&P 500. It is the strongest month. Now, before I give you all the numbers here, I'm going to switch this over the Thanksgiving holiday. I actually went back and I sorted all S&P 500 companies. Well, first I filled out the seasonal numbers for every stock in the S&P 500, January through December. And so as I scroll down here, you're going to see there are 500 companies here listed. And I'll explain how I sorted here in just a second. But what I did is I took a look at the, well, this column right here there's no title up here, but essentially what this is a total of all of these monthly averages for each stock coming across. So for instance, on Keysight Technology, KEYS, if you take the total of all of these monthly returns, you'll come up 19.4. This column is simply the addition of December and January. So I'm looking forward to the next 2 months. And you can see that KEYS is the worst performer, because this is the column I've got it sorted by. It's the worst performer on the S&P 500 in the months of December and January. However, let me also caution you, be careful. This is the number of years that we have history for. So the max is 20, but you can see KEYS only has 5 years of history, and that's not as reliable, in my opinion. You know, when you look at a sample size, it's really, the more data you have, the more representative it is. And I would say at this point, you know, when I look at a stock, it's got 5 years worth of data. That doesn't, it doesn't weigh nearly as great for me as a company that's got 20. And the reason being, you know, if you just think about the last 5 years and what the market has done, we've had no bear markets. We've had a couple corrections, but no bear market. And if you go down here and you see stocks maybe that only have like 8 or 9 years, I'm sure here's one, KMI, there's only 8 years. Well, that basically is the bull market, or 9 or 10 years. So if we look at their history, there's 9 years, GM. So they've only got history dating back during one bull market. All these other stocks that have 20 years have gone through 2 bear markets. So I do think that there's something to be said when you look at these different stocks and you start comparing them. You want to make sure that, you know, you're looking at apples and apples instead of apples and oranges. And I think the number of years data in this particular look back period is really important. So I tend to focus on companies that have at least 18 years showing on here, because that tells me that it at least takes us back to year 2000 and includes 2 bear markets. So this is the column that just sorts, you know, that adds December and January, and I've sorted it. So just based on this number alone, it's telling me that KEYS is the worst performing stock on the S&P 500 during the months of December and January. But again, probably going to throw that out because it's only had 5 years. Then you've got HBI and so on down the list. I'll let you take a look at this while I read through some of the numbers on the overall indices. S&P 500, first of all, we are in a period right now. Well, before I even get into that, S&P 500 since 1950, December, we have seen the S&P 500 rise 50 times and drop 17 times. It is based on the percentage of times that the month moves higher. It's the best month of the year. Also based on annualized returns, 19.51%. It ranks as the best month of the year. And that goes back again since 1950. So that's not just using the 20 years that we have available here at StockCharts. I have a spreadsheet, Excel spreadsheet that has that data through 1950 or back to 1950. So that's 68 years worth of data. Pretty powerful stuff. The NASDAQ since 1971. So we're talking about 47 years, 28 and 18. It's risen 28 times. It's fallen 18 times. Annualized return, 23.44%. That's good enough for second place out of the 12 calendar months. The NASDAQ likes January. January is the #1 month. Russell 2000 since 1987. So we're going back the last 30 years. It's risen 26 out of the 30 years. Only 4 declines on the Russell 2000 during the month of December since 1987. One of the reasons why I am currently trading the IWM. We hit major support, and I know historically we're in a really good period. That 34.08% is easily the best month of the year for the Russell 2000. So now let's talk about notable periods within the month. November 22nd to December 6th. We're in the middle of that period right now. On the S&P 500, annualized return just for this period, it's 14-day period, 2 weeks, 33.71%. That's almost 4 times the S&P 500's normal return throughout the year of 9%. So definitely we're in a bullish period right now. I do want to tell you, actually, and I'm going to, before I go any further, I'll bring you back to this page in 1 second. But I want to show everybody one other. Let's go into the blog articles. There was a really good article that Dave Keller wrote, and I want to just make sure everybody has seen this because I'm a big fan of seasonal information. It's somewhere on here. There it is. Seasonal, and his blog's The Mindful Investor. And his article yesterday, Seasonal Trends Are Not Seasonal Certainties. Really want to check that out when you get a couple of minutes. I completely agree with Dave. I'm a big fan of seasonality. I think it's really useful information. I use it many times to confirm what I'm seeing technically. But it's really important that you don't use this as your #1 go-to. If the market is weak technically, and seasonality tells me, hey, we're in a great bullish period, that guarantees us nothing. And Dave had an example of the Friday after Thanksgiving, and I posted last week in my blog, the Friday after Thanksgiving is one of the most bullish days of the year. Dave referenced that in his article, and yet what happened? The S&P was down, the NASDAQ was down. I mean, we saw our major indices drop. Not a guarantee. Don't, mortgage the house. And put that into the stock market because there's a trend in play. These are not certainties. They're not guarantees. So keep that in mind. All right, let's go back and take a look at that spreadsheet again. Okay, so there you go. Let me get back into the numbers here again. Okay, so the S&P 500, I want to break down December for you. We know that through December 6th is bullish. The 7th through the 15th, though, is pretty bearish. And so listen to the returns on the S&P 500 since 1950. If we break it down between the first half of the month and the second half of the month, December 1st through December 15th, the S&P 500 has an annualized return of 2.91% since 1950. Not that exciting. First week's pretty bullish. Next week or so is pretty bearish. And it just averages out to a 2.91% average annualized return. Second half of December, 16th through the 31st, annualized return 37.36%. December is really strong. It starts off strong. We go through a period of, profit taking. And then the second half of the month, you get the Santa Claus rally, the holidays, people are in a festive mood. I think there's a lot of psychology involved in it. But the stock market goes up, and the percentage of days that it goes up, I don't have the numbers here, but I know from prior studies, the percentage of days that it goes up skyrockets as well. For instance, the S&P 500 since 1950 has gone up 53% of the days. So simple math will tell you it's gone down about 47% of the days. When you get into this last 15-day period in December, that number jumps to about 65% from 53. So you've got a much greater chance of having up days in the second half of the month. Again, not a certainty. We've had down Decembers. We've had down second halves of Decembers. But the tendency is very bullish. All right, Russell 2000, current period that we're in. And by the way, I'm going to skip over the NASDAQ. NASDAQ and the S&P, very similar. Russell 2000, November 22nd to December 6th. Annualized return, ready for this? 70.55%. December 7th through December 15th, minus 41.20%. December 16th through December 31st, plus 73.06%. So if you break it down by first half of the month and second half of the month, well, obviously the second half of the month is at December 16th, the 31st number I gave you, 73.06%. First to the 15th, though, because we start off bullish and then turn bearish, actually the first half of December, minus 2.77% on the Russell 2000. So it's like flipping a switch at the middle of the month. Keep that in mind. We'll want to take a look at that, see where we are technically in the charts as we get toward the middle of December. All right, so that gives you a general sense of the overall market and some of the, the different indices and periods within December, some things to look for. Now let's talk a little bit about sectors. So I'm going to switch this back over and let's pull up some charts. First thing I want to do is tell you that from a sector perspective, and this is going to answer the poll question for those of you who haven't answered yet. So a little bit of cheating. But XLV, healthcare. If you take a look here over the last 20 years, December has averaged going up 2%, and January up 1.1%, and November 1.7%. We're kind of in a sweet spot here for healthcare stocks at the end of the year. And if we compare it to the S&P 500, and you see, first of all, December 0.6%, or excuse me, 0.7% outperformance above the S&P 500. So if I simply get rid of the S&P, I'll come back to this. But again, look at that's the outperformance, 0.7. The actual number is 2.0. So that means that the S&P 500 is around 1.3% average return in December over the last 20 years. All right, so let's head back here. Let's take a look at the S&P again relative to the S&P. And I'll do another seasonality report as we approach January. But I try to look out the next couple of months a lot of times. So in addition to December being strong, we want to kind of have an idea maybe if there's a continuation for some of these areas. And there is for healthcare, as you can see. That healthcare has outperformed the S&P 75% of the time in the month of January and outperformed on average 1.6%. So we're seeing a lot of outperformance by healthcare in December and January. If you add those two numbers up, 0.7% and 1.6%. Again, this is not what the healthcare performs at on an average basis. This is what they outperform. The group outperforms the S&P 500, 2.3%. And if you look at any 2 consecutive months across the board, nothing else is even close. 2.3% is clearly, this is the time of the year for healthcare to shine. So something to keep in mind. So what lags? Might find this one interesting. Technology. Technology in the month of December lags by 0.9%. And when you look across all of these months, it's the worst relative performance of the year. Over the last 20 years, technology has performed worse on a relative basis in December. That's the worst month that technology stocks have. But that's not the worst group on a relative basis. Well, at least I don't know if it's, let me see. I'm not sure if it's worse. If consumer staples were worse. No, actually consumer staples, only 0.6%. But these are the two worst as you go forward in the month of December on a relative basis. And looking at January, you can see that relative underperformance continues. Now with the XLP, we're talking about a defensive group. And December and January tend to be really strong months for the major indices, especially January for the NASDAQ. So that's why when I pull up that XLK and we pull up the same chart on a relative basis, look at that jump. January is the second best month of the year for technology relative to the S&P. The only month that beats it over the last 2 decades has been October. So if you want to know why consumer staples are lagging in January, well, it's because the NASDAQ does very well and technology leads the charge. So you want to be careful as we head into the last couple of months historically with consumer staples. So looking at industry groups, we know healthcare is strong. So which groups within healthcare outperform? Well, we've talked a lot about healthcare providers. And when you look at the chart, this is a group, I mean, we are in a sweet spot right now for healthcare providers seasonally. 2.6%, the group averages outperforming in November above the benchmark S&P, 2.3% in December, and 1.4% in January. And once again, you take those 3 months, add them together, you're talking about 6.3% on average. Healthcare outperforms the S&P 500 over the last 19 years. So healthcare or healthcare providers is one of the strongest groups technically, and we are still in a sweet spot for the group. So for me, this is more confirmation that healthcare providers is a group that I want to continue to watch and trade. Now, a more interesting group within this space is medical supplies, because medical supplies have not been nearly as strong technically. But look at December and then especially January. 78% of the last 2 decades or 19 years, we've seen medical equipment index outperform the S&P 500. 78% of the time, and the average gain 2.5%. Tack that on to December's 1.6%, and you can see going across here at the bottom, these are the 2 best months for medical equipment companies on a relative basis. So you see a medical equipment company that you like technically, keep in mind that historically we're in a seasonal sweet spot. And then finally, I'm going to throw in there the biotechs within healthcare as well. Not as much with the biotechs. I'd say July is the month you got to really keep an eye on here, right in the middle. But we do see a little bit of outperformance in December, although biotechs have only outperformed 37% of the time. I prefer when I'm seeing outperformance, I'd like to see this percentage chance a little bit higher. Look at January, for instance, 70%, or July, 75%. And then in January, outperformance is 2%. So, yeah, we might see a little bit of relative strength in November and December, but January probably is going to be a better month. But it still does show, on average, outperformance. So I wanted to highlight it. Now, lagging, we talked about consumer staples and technology. So what areas in these 2 sectors should we be careful of? Well, one is sodas. The soft drink index, if we take a look at the last 19 years, soft drinks have underperformed in December by 0.6%. And their worst month is January, only outperforming 33% of the time, meaning they underperformed 2/3 of January's going back the last 2 decades. And the average underperformance is 1.5%. Looking across the bottom, these 2 months, easily the 2 worst months on a relative basis for soft drinks. So December, January, maybe it's the winter time. Who knows? I don't know. But the numbers are there. Looking at technology, I want to bring up 2 areas. One is computer hardware. And when we look at computer hardware, we see that on a relative basis, computer hardware only outperforms the S&P 33% of December's. And the relative underperformance, minus 2.3%, is easily the worst month of the year. And so why is that? Well, Apple. Apple doesn't like December. Relative to the S&P 500, it goes up only 32% of the time. And the average underperformance by Apple, minus 2.3%. Now, if we get rid of the S&P here and just look at Apple's absolute performance, we will see that over the last 20 years, it's gone up 53% of the time, but it has a minus 1.1% average return in December. And you might think that September minus 2.5 is worse, but keep in mind, September is a bad month for most stocks. December is not. So that's why it looks like on an absolute basis, September is Apple's worst month. But if you're looking at it as a, from a relative performance to the benchmark, actually, if we put Apple back in here and we take a look at the S&P, December you're going to see is worse than September. The fact that it lags, the only 2 months throughout the year that it lags the S&P, you're looking at a really strong stock over the last 20 years. The only 2 months it underperforms is December and September. And I would say December's is much worse, not just because of the minus 2.3%, but also because it's only gone up, outperformed the S&P 32% of December's going back the last 2 decades. So those were the stocks. And we could take a look at Apple right now and pull that chart up. And we know from what's been happening, we're in a downtrend and we're going into the worst month for Apple on a relative basis. So what does this tell me? Well, it tells me that if Apple does continue to climb and we get up maybe to that 20-day test, I'd be really careful if I owned it, especially from a trading perspective. I'd be out of it. Long term, I think Apple's a great company. I think 3-5 years from now, we're not going to care what the heck Apple did at the end of 2018. But if you're a trader, you care what happens in 2018. And I think Apple, if it moves back up into the mid to upper 180s, is going to run into some problems. And seasonality won't help. Okay, let's take a look. I'm going to go back now and let's go back to that spreadsheet, because you were looking at all these companies that were underperforming. I actually wrote about this one, HBI. Let's pull this chart up. I'm going to go back over and pull up the chart on HBI. First, we'll look at the technicals, then we'll pull up the sentiment or the seasonality chart. But here's a stock that's been downtrending for quite a while. And if I go to a weekly chart over the last 3 years, I mean, this is a stock that has been getting beaten up pretty good, and it continues to decline. You'd never know we were in a bull market if you looked at Haynes Brand's chart. We're just continually breaking to new lows. And the fact that now we're going into December and January, where we are entering the worst historical period of the year for the stock, tells me that if we get a bounce, I mean, if I was into shorting and we got a bounce on the stock, actually it already is up to the 20-day moving average. I don't know, this might not be a bad area, but certainly the most recent high, you got gap resistance at 17. If we were to get back up to the 50-day, you could really keep a tight stop on a short in anticipation maybe of another move to the downside. But again, keep in mind, I don't believe at this point we're in a bear market. I think there's a lot of things that have to happen before I'd be willing to talk about confirmation of a bear market. And by the way, I got a question. I'm not going to go over it right now, but I did get a really interesting question, and it makes sense. I will read you the question and then maybe try to answer it if we have time later in the show or maybe an upcoming show. But the question was, Tom, I've heard you say repeatedly that you're looking for confirmation of a bear market, and that confirmation would be a break beneath the February S&P 500 low of 2582. Let's say the S&P 500 does in fact break below those lows. At that point, the S&P 500 decline would be approximately 12.25%. Wouldn't that mean you've missed most of the bear market already? I don't understand what that confirmation would mean in terms of trading strategies. Could you please explain? There's a lot that goes into that answer, but I'm just going to shorten it real quick and just say bear markets don't last 2 months. If this truly is a bear market and October marked our high, most bear markets last a year or longer. So we could be looking at a much different market as we go forward, and I'll try to expand on that at some show in the future, maybe later. At the end, maybe Aaron and I can have a discussion about it. But anyhow, I just wanted to bring that up because I thought timing-wise, it hit me in the question. I didn't want to ignore the question, and I will get back to it. All right, so there's Haynes Brand. So this is kind of on the downside stock that you might find compelling in terms of if you were looking for a short. Now there are many others on this list. What I would do is, well, I mean, you could see like, well, that's only got 5 years. That's networking company. I'm trying to see like some of these companies, like right here. Okay, QRVO. 20 years worth of data. It's averaged 29% a year if you add up these going across, and yet December is minus 5.3%. Probably something to that. And a stock that's performed that strongly, showing that, between December and January, we do have average gain in January. But between those 2 months, it's actually fallen 3.3%, even though it's got a very, very strong number. We could look down at Celgene, same thing. And actually, Celgene's got negative returns in both December and January, and that's definitely another downtrending stock. Those are some things that I might look for based on this this analysis of the S&P 500. So what stocks might we look at from a positive bullish standpoint? I'll just give you a few of these and then maybe take a look at the charts. Netflix, believe it or not, nearly half of its gains have been attributed to December and January, especially January. So we've got a very, very strong month of coming up seasonally for Netflix as we approach January. Keep that in mind. Illumina, look at January, 13%. December, 2.4%. 47% of their annual gains is typically found in just December and January. And some of these others, another way to sort this, I don't have it here, but would be to sort it based on the annual number, with the highest being first, and then looking at the percentages to see which companies have most of their gains in the last couple of months of the year. So I'm looking for maybe companies over 30% that are in this area. I mean, we already talked about Illumina and Netflix, and I'm going to look at both those charts in just a second. Maybe a third one to include might be SBAC. I think that's a REIT. And maybe CTSH. So I'm just going to jot these down. We'll look at these 4 charts: Netflix, Illumina, SBAC, and CTSH. Let me look at these 4 charts and then we'll wrap this up. Okay, first up, Netflix. Well, Netflix does like, the month of January. December wasn't nearly as much, and we are hitting a 20-day. The move to the upside here, this is nice, another gain on top of yesterday's, but there's a lot of work to do here on Netflix. We did get back through 270, 275, which was step 1. 20-day moving average would be step 2. And then I think more importantly is going to be on that longer term chart, the weekly, getting back through a declining 20-week moving average. Now, if we get back up there, we're talking about being up around 315, 320. That would be a nice gain from here. I think if the seasonality kicks in, the market does have a nice bounce. I don't think that's out of the question. I think that's very possible. But if I got up there, I would be out of Netflix. I think you've got very serious price resistance and those moving averages up there. So first, Netflix, let's see if we can get through the 20-day. But based on seasonality, if we get through the 20, there is a good chance that we could see continuing move to the upside in Netflix in the near term. ILMN. This is a biotech stock, by the way. And we talked earlier about biotechs doing pretty well in December and January. This is one of the better biotechs. I think we were talking about Celgene the other day and maybe Gilead. And I pointed out both of those on relative charts and said, these are not the kinds of stocks that I would own if I wanted a biotech. Well, I would say that Illumina is one of the stocks I would want to own. Look at the relative strength of Illumina versus the biotechs. And we also know seasonally the stock loves the months of December and January. So if we get a breakout here above this 345 area, I think there's a good chance Illumina makes another run for 370. To the downside, rising 20-day moving average is something to keep in mind. SBAC, we'll look at this one on a relative strength basis as well. Here you can see the overall group continues to move up. I think I've seen this one listed in some. This is showing the DJUSWC, which is telecommunications, wireless. I'm just going to pull the chart up here. So here's the chart of the mobile telecommunications group, and that's been very strong. But I've seen SBAC listed in with other areas of the market. But anyway, let's ignore that for now. We do have a stock that has been performing very well in October, latter half of October and into November. Came down, went a little bit below the 20-day, but now strengthening again. And as I mentioned earlier, this is a stock that tends to make a lot of its money in the months of December and January. So technically, I think it looks pretty good. Resistance needs to be monitored around 175, but it looks like based on history, we'll probably at least get up there and test that and then see if we can break out. And then finally, the last one is CTSH, which is Cognizant. Yeah, Cognizant Technology. Now, this one technically is challenged. It's been in a downtrend. Recent failures around 71, 71 and a half. 50-day moving average, which we couldn't get through back in September, October, is at just below 72 at 71.90. So 71 to 72 is a really big area of resistance here. And as you can see, the group was actually breaking out to a new high in early October, and Cognizant was not anywhere near. So on a relative basis, the stock was not performing well, but it has begun to perform better. And if we make a price breakout, get above the moving average, we do know that the stock has a seasonal track record of performing very, very well in the months of December and January. So that's another stock definitely worth keeping an eye on as we move forward. All right, why don't we do the summary slide? Let's see, take a look at that first, and then we'll pull up the poll. But this is just, again, just a quick and dirty summary of the things that we just talked about. The fact that December is a very strong month in terms of other calendar months. December is very strong. Talked about the leading and lagging sectors and industries, and just went over a number of individual stocks to keep an eye on. But I did update the spreadsheet, like I said, last week over the holidays. And so I do have that going forward, and I will be using that quite a bit in both my blog and then also when we do these seasonality reports each month. So we have that to look forward to as we go forward. All right, let's take a look at the poll and see what everyone, I gave the answer away.
That you did.
All right, a lot of folks must have already answered because they went consumer discretionary and technology. And technology, like I said, technology is the worst performer, or second, well, actually it was the worst performer on a relative basis in December, although it does pick up in January. So maybe a little bit of a trick question there. But healthcare, on a relative basis, healthcare is definitely the best performer over the last 20 years.
Wow. Yeah, I admit I didn't pick that. I picked consumer discretionary, just mainly off the top of my head, thinking Santa Claus rally, that sort of thing.
Mm-hmm. It's kind of interesting when you look, because the one area of consumer discretionary that loves December and January is not what you would think. It's home construction.
Wow. December. Okay.
But if you think about the way the market works, looking ahead,
mm-hmm.
Most of the time we're in a period of economic strength. We do go into cycles and bear markets and recessions and so forth. But for the most part, the U.S. economy grows and people's income goes higher and that sort of thing. So if you believe in the fact that the market looks ahead to what it might be seeing in March, April, May, June in terms of new home sales and things like that, maybe it makes sense that folks are getting in ahead of the curve. Right. But anyway, kind of
interesting. I always like your reports. They're always really fascinating to me. I remember seeing you do a presentation on this at one of the chart cons early on that I was at, and I just thought it was so interesting to hear about, even down to the days of the week, that you'd studied and which ones were best and that sort of thing.
Yeah, I think some of it, well, I do think Mondays, I think there's a psychological component. Mondays are the worst by far. And we go through periods where Mondays do okay, but I mean, I'm talking long-term S&P 500 last 68 years. It's not even close. And I think Mondays there carries a psychological, who wants to go to work on Mondays? I mean, not the Friday blues, it's the Monday blues, right?
I suppose, but I know you and I don't have it because that's Monday setups day. That's always fun.
Well, not this week for me. But for you, yes, I understand.
Yeah.
Look, but we'll get into that on Monday. But anyway,
yes.
Yeah, I'm a big fan of history, and I'm a big fan of seasonality, but I do also agree 100% with what Dave wrote about. It is a tendency only. It is not a guarantee. So, when I look at a stock like CTSH, that I pulled up last, that was in that downtrend. Yeah, the seasonalities tell me to get in, but the technicals are telling me no way, not right now. Let's get a breakout, or let's get a pullback, or actually a pullback probably wouldn't make me feel any better. I'd like to see a breakout with some volume. But if we got that, then I think the seasonal pattern helps to confirm. But anyhow, we probably went a little longer than necessary there, but let's go into the 10 and 10. What do you have from an RRG perspective?
I hope people like it when we chat like that, but all right, let's go ahead and look at the RRG for the 10 and 10. Have that all ready to go. What I wanted to show you, obviously, we've got the nice rotation going on here, but look at what is in the lagging, the weakening and lagging. They're mostly technology, and healthcare is in there. So I thought that was rather interesting. And as far as sectors requested, look at technology. Certainly the one that everybody is mostly interested in right now. So we'll look at those for sure. But first stock up is Evertech, EVTC.
All right, Evertech. Well, I would say that this is a classic TA 101 example right here. You can see the high that was established, big bearish engulfing candle off of an uptrend. That usually is a signal. And I know when you got a stock that's up at 26.5 or almost up 26.5, and it closes at 24.40, the last thing you want to do is sell, because just from a psychological perspective, it's like I could have sold it earlier today at 26 and change. I'm not going to sell it at 24. I'm going to wait until it gets back up to 26. And then invariably, you can see what happens after that. That's a pretty good reversing candle. And then what ends up happening is you panic out. You see a stock back down looking like it's going to break below support. You get out at 22.40, 22.50. And then the next day it's back up to 26 and you're ready to shoot yourself. Everybody's done it. I've done it. I'm sure, Aaron, you've done it. Everybody has done it. And it just happens. But I do think you need to pay attention to these big reversing candles. Look at these tops. Bearish engulfing candle, dark cloud cover, bearish engulfing candle, bearish engulfing candle. Every one of those led to short-term weakness. So when you see these set up on your charts, especially after an uptrend, pay attention. But the other thing here from a technical perspective is we got the breakout above that prior high at 26, get all the way up to 29.50. You're feeling really good. And then 2 weeks later, you're miserable because you held on. You went all the way back down to 26. But broken price resistance becomes price support. You hear that a lot at stock charts. Just about every one of us, all the senior technical analysts here at stock charts, refer to this being one of the basic premises of technical analysis. And we saw it right here. Came right down to price support. Went a little bit below, maybe 10 cents. And now we're bouncing again. So I think you're in a uptrend. I think this is a bullish looking chart. I think your support now has been established here just below 26. And I think your target is up above 29.5.
All right. The most popular in the chat room is AMD.
Yeah, AMD had a really nice last few days, and actually a pretty nice uptrend here. But it is hitting some key overhead resistance. And I think this is where the market's we're going to find out a little something on the market in the short term. Are we just going to roll back over and head back for the lows, or is this going to be a little bit more of an intermediate term bounce? I know when we had Greg Snell on the show, he was pretty bullish about the short term, meaning, or maybe even intermediate term, meaning that this he thought could go on for weeks instead of just days. And I think some of the stocks, one being AMD, is going to be a perfect example of how far we can go. I mentioned Netflix earlier. You look at AMD, it gapped down on heavy volume in October. We haven't quite gotten through, we haven't even tested the top of this gap resistance yet. But you can see that the most recent reaction high, we got up there again yesterday. We're kind of pulling back a little bit. Volume was good yesterday, but we couldn't get through. I think 22.23 is an area to watch here on AMD. And if we don't get through it and start to roll back over, lose that 20-day support, it could kind of argue for this being just nothing more than a little short-term oversold bounce.
Okay. Excellent. You might have heard of this one, Twitter, as our next one. TWTR, of course.
Twitter was getting hit really hard. Well, it's bounced back off the lows, and that was a reaction low, pretty important short-term support, I would say. And notice it went just below. And again, all that does is just trigger a bunch of stops, and then it reverses. If it can continue to strengthen here, I think short-term, that would be a good sign. More intermediate term, we got a downtrend in play. I think we got to be careful. But we got a gap up on heavy volume. I would have expected maybe this area up in here to hold, or maybe even draw it down to that low that this day right here on the heavy volume. But anyway, we went right back down into this area. We did gap below the support, but the buying came in immediately. And when we hit that 30 level, same thing. Buying came in immediately. PPO above the center line. So at least the bulls have a little bit of control here in the short term. Don't lose $30. That's what I would say.
Okay. All right. Next one I have for you. Let's see. SCI Service Corp. This is Special Consumer Services Industry.
Breakout yesterday. Volume so-so. Not bad, but not great. So maybe a little bit of a mixed picture, but I like the PPO. I like the confirmation and the follow through today. I would just say this, because the volume wasn't great, I think if you get a breakout and you get a false breakout, in other words, go back down, close below 45, I might be a little bit cautious. I mean, maybe if you want to give it the rising 20-day, I'd be okay with that, a little bit more room to the downside. But this on a breakout with decent volume and now confirming today with a strong PPO, I'd like to see this hold. So 20-day to the downside would be my line in the sand for sure.
Okay. Let's see. Next one is going to be Deere & Company, DE.
Nice short-term breakout. Still got some work to do. I'm going to stretch this out to a year and see where this was back on the January time frame. Yeah, I mean, definitely we're going to have a really big area of resistance. If we can negotiate 152.5 and we hit 152.49 today, then I think we're going to, if we can get through that level, I think we've got a really good chance to maybe get back up and push to this overhead resistance. And I'm going to use this prior high, or these prior highs right here. It's kind of the overhead resistance. So what I would be looking for is maybe 158 to 160 if we can negotiate this 152.5 area. Now, when you look at the longer term, and I'm talking about from the May low right down here through the resulting reaction high back on the 21st of May, I think we've established a very important area of support and resistance. It's big, pretty wide range, 130 up to 160, but I would honor this. I mean, as we get close to 160, I'd be a seller until we can get through. You can see multiple times getting up 158, 159, can't get through 160. We turn back down multiple times down around 130, 131. We don't close below, and then we turn back up. Honor the range. You have another one, Aaron?
Oh, I'm so sorry. All right. Yeah, I'm getting pinged over here. All right. The next one for our Canadian friends, CGI Group. And listen closely because this is an unusual one. GIB/A.TO.
All right. Let's see here. Wow. Well, I mean, 86, obviously, there were a lot of tests of 86 where we couldn't get through, going back into August and September here. Then we fell from there on some pretty big volume. Now we're making our way back up. I think right now you got a strong PPO. The rising 20-day moving average should offer up some support, and it has been for the most part. So I would say to the downside 82, to the upside 86, and I would just trade that range until we see if we can get a breakout. A breakout above 86 with some increasing volume would be bullish.
All right. Let's see. A software company for you. TRHC, Tabula Rasa Healthcare.
All right. TRHC. Well, the overall uptrend remains in play. You know, when you get a pullback and then you rise to new highs, here was the pullback. So I'm going to put that as support. Here was the move up. There's your high, pullback, new high. You don't want to lose this low. And notice where we went to, right down to the support area. And we talked about this in my gap trading strategies. Now, this wasn't a gap, but you can see what happens when we hit price support. And this, when I say, you know, your reward to risk is best at certain levels, this is a perfect example of it. When you get a stock that's moving down, if you believe that this is going to continue in an uptrend, the best time to get into the stock is when it's testing that prior low, because you don't have to have much, you don't have to give it much downside. Instead, we've had 7 consecutive days of gains now off of that level. The stock has risen, and I know there's no way to forecast it when it's hitting this level, but it's now up almost $20 in 7 days, or roughly 17, or no, actually no, 30, 35%, something like that. Pretty big move, no matter how you slice it. But TRHC, I think, looks good, but we do have some overhead resistance. We have had multiple tests in the, I'm going to say 79 to 82 area. So if I was in it on this uptrend, we're probably going to get overbought. Also, look at the volume, not been very strong on this move. I might be taking some profits if I was in it, to be honest. I don't like that lack of volume on this move back to the upside as you get closer and closer to overhead resistance. So I'd probably take the conservative side and take my money and run.
All right. And because I know you love it so much, gold, Randgold Resources.
Yeah, well, yesterday the dollar took pretty big hit after the Fed was done talking, and I think must be down earlier. It must be down again today, because I saw that material stocks, well, it was down, but now it's bounced back up. See, I still like the dollar to go higher, so it's going to be hard for me to be bullish gold. But I'm sorry, now I've lost the
Gold, Randgold Resources.
Oh, GOLD. Okay.
Mm-hmm.
Let's see. Well, as I take a look at this drop, actually, I could look at this drop. There's a reaction high. Here's another drop. There's a reaction high. And then it's just been this long, steady decline. We now have a triple top in at 85. Short term, it looks pretty good because it's been holding. And I would say off of its uptrend. Here's your uptrend. Sideways consolidation. But these tops do line up with this top back here in March. So I'm not bullish gold overall, but I could be okay maintaining a bullish call on this stock so long as it doesn't drop below. And I'm going to say if it closes below 77, I would be out. Off of this move, we closed here at 77. We moved up, tested 77, moved up, came down here, candle body low 77, moved up. I think this is, you can kind of see this is a pretty important trading range to follow. So if we close below 77, not only would we be losing the price support, we'd also lose the 50-day moving average. That is my line in the sand. So I don't like gold overall, but the stock gold is okay, and I'd be okay holding it as long as it holds $77.
All right. 2 more. The biotech for you, EXAS, Exact Sciences.
All right, this has been a pretty good one, and listen, I'm going to do this one on a relative chart. But a couple things here. Number one, on a relative basis, remember I said Celgene wasn't good, Gilead wasn't good, Illumina was good. Well, EXAS is good too. Nice move to the upside on a relative basis. It's one of the leaders. I think also check out this gap support hold. I mean, we talk about gap support and trading gaps. How about a hammer right on gap support? Oops. Right there. See that where we had closed about $64, gap up to 73, do all this a little bit higher, and then we make our way all the way back down. Intraday, we go below the gap support level. End of the day, we finish above it. That is a buy signal. 6 days later, the stock has gone from 64 to 77, 76 and change right now. Now, would I buy it here? No, I think that there's too much risk involved. I think we're now in a range between probably 64 and 80. Stock's trading at 76. So I think there's much more risk to the downside at this point. But I like the stock. So maybe on a pullback to a rising 20-day test, that might be something to consider. Otherwise, I would just hold off for now. But this is a solid relative performer.
Okay. Excellent. And the last one is a consumer staple, Chef's Warehouse. Chef, C-H-E-F.
Okay, pretty good performer, but right at resistance. One thing to look for is maybe a false breakout. You can see the group has been going down, but the stock has actually been rising. Overall, not bad, though. I mean, we have equal highs coming across, rising lows, pretty good pattern. Relative strength is good. Really across the board, nothing really to complain about here. The only thing I would say is as a short-term trader, let me go ahead and annotate. As a short-term trader, watch the closing high here at about 38.25. If we get a tail, especially a tail that goes up above this prior tail on October 5th, I guess, and then we come back down and close back below the resistance level, that to me would indicate maybe a short-term tops in play. So you want to be careful with that. Otherwise, I think this is a pretty good looking chart. I just don't want to buy at resistance. I've shown you enough times where once you move up, come back down and go back up, how many times you go back down again. So this could turn out being sideways consolidation where we move back down to 30 again. So I wouldn't take any chances and take it for granted that we're going to go through this 38.25, 38.50 area. I'd have to see it first. And once again, with the light volume move to the upside, it wouldn't be horrible to take some profits here.
All right. And that does complete the 10 in 10. And here you can see all of the stocks we just went over. Those will be up in the Market Watchers live chart list after the show. Just go to the blogs tab, click on the Market Watchers live blog, and you'll find the link to that chart list right there at the top. All right, let's go ahead and get on to our final market update. Looks like the markets are trying to make a comeback here. I haven't checked what the Fed minutes said. I don't know if that's quite out yet. But in any case, we started lower on the day, but we are trying to make our way back up into positive territory here. In fact, Canada has been in positive territory most of the day, and currently it is the only one in the green, up 0.12% actually. S&P 500 and the Dow are both down about 0.25%. NASDAQ, you can see also with this V shape, the intraday low hit, and now we're finding resistance really at yesterday's close. S&P 400 though, excuse me, has made it into positive territory. At least it was up there for a little bit, and now it has fallen back down. Currently reading 1868.05 for the S&P 400. Russell 2000 lower on the day slightly. Currently looks like it's down 0.17%. Treasury yields are lower, but coming back up, currently reading 3.037%. VIX, look at the spike. We had a spike up to 20.5, but we are starting to come back down closer to the 19 level. UUP, the dollar, up slightly. Gold was gapped up, was looking like it was going to have a great day, but it has pulled back quite a bit. GLD is right now at 115.72. USO making a bit of a comeback here, but as you can see just from the last couple days of trading, we really aren't seeing a breakout yet on USO. I think we still got some downward pressure to worry about, but currently it's up almost 3%. Reading $10.97. And TLT had the big gap up, but did pull back as well. But it's currently up 28 cents at 114.73. And that's all I have for our final market update. Let me pass it back to you, Tom.
All right. I'm just going to go in and look at a chart that I had in my blog this morning. And, you mentioned the VIX, and this is one of the problems I do have with the market in the near term. And I've talked about this before. But when you go back to the last two bear markets, we never went below 16 on the VIX. Back in November, when the VIX dropped, you can see that was when we had the big spike on the S&P 500. And then as soon as the selling kicked in, you can see the VIX bounce right off that 16 level. That's a level I'm going to continue to watch down the road. But yesterday, the action that we saw when we had these huge rallies off of prior lows, when we had these big hollow candles, we generally had really big moves down in the VIX. Which helped us signal that perhaps we might see some sustainability. And in most of the cases, we did see some sustainability to the upside. The only one that really failed was the one that we saw in October. Now, yesterday, we had perhaps the biggest of all of the prior moves. I mean, this was really a nice move in the market. The VIX dropped 2.7%. That's a problem because volatility is remaining elevated. That tells us there's still a lot of fear out there. And what it also tells me is that if this market gets any bad news with a VIX elevated like this, it's probably going to sell off hard. So I'm still pretty cautious on the market. I don't believe that this is a bear market just yet. I do think we need to confirm, but I think based on what's taking place right here, just be careful not to get too comfortable. I do think the market could rally some more from here. I'm not quite sure which way it goes, but I would just say that if it continues to move higher, we want to follow the VIX. We want to follow the sector leadership to see what's leading the moves and continue to evaluate it on a day-to-day basis. I would not just buy and leave this market for 2 or 3 weeks. I think that would be dangerous.
All right. I have to agree with you. And let's talk a little bit more about it right now. I'm going to give you my case for a bear market. So basically what I'm doing is I want to go over some of the information that Carl gave us last Friday in the Decision Point blog. And then I'm also going to go over what I wrote about on November 20th, a couple days before that, as far as what I'm seeing and why I'm really thinking we are in a bear market at this point. I have to say I'm with my dad on this. I don't like it. I don't like what's happening. But let me show you technically why. So I wanted to just give you my thoughts on that, and whether you agree with me or not, that's your choice. But you can certainly give me your impression, Tom, after I'm done. But let's go ahead. I'm going to start with Carl's DP Weekly Wrap. And of course, the title says it all. Looks like a bear to me. What I wanted to show you mainly was this chart that he did. This is a monthly chart. And he is pointing out the fact that we have a PMO sell signal gelling. It's not actually going to be finalized until after the Friday close tomorrow. So the monthly charts and any signals that appear on them aren't final until the last day of the month. I think we had all been crossing our fingers that we would not see this sell signal, that it would turn back around, because it's been in play on my radar for about 2.5, 3 weeks now. So I was hoping it would make the turn, but clearly has not. I'm going to give you let's go to the live version. Not that there's that much different here, but there you go. There's that monthly PMO sell signal that's lined up. And, you know, we were looking at this cyclical bull market trend line, and the thought had been, let's see if we can hold this. And, you know, if you look in the thumbnail, we came up as far as the close, right along that rising bottoms trend line. And right now, currently, we're just trading just slightly below that rising trend line. I wouldn't say that we've kept this rising trend, only because we have broken down below it. It looks like we maybe have taken in the shorter term a little less steep move right now, if you want to be on the bull side and look at this as a rising bottoms trend line. And I know I did point out in my blog yesterday, because lots of people were looking at it, the possible double bottom off of yesterday's rally. And I think it was just a relief rally. I'm not convinced we got a double bottom pattern there. Really am not. All right, so that was one of the things that he pointed out that I thought would be important for you to see. I'm going to show you I'm going to make my case using the PMO, and I'm going to use it for the daily PMO, the weekly, and the monthly, so that you can see what I'm seeing right now. What I did is I was really curious, because I had said on previous Market Watchers, I think a couple of weeks ago, or a week and a half, 2 weeks ago, that, you know, I hadn't really lived I haven't lived through a serious bear market. And I say that because while I did study, I was still studying the market and working for Decision Point during the last one, 2007, 2008. Admittedly, my number one job was being a mom. So I stepped out a little bit to do that. So I don't feel like I was really, you know, that technically involved when we were in that last bear market. And so what I wanted to do was look at a bunch of bear markets, because I haven't lived through them. And I wanted to see if there were similarities with our PMO somewhere in there. And I did find some. So let's go through. I have written about these PMO sell signals that all turned up on the DP scoreboards on November 20th. Of course, if you get a more recent chart after yesterday's big rally, we did see a PMO buy signal appear on the S&P 500. But, you know, really when you get a rally that strong and you've got that thin of a margin between the PMO and its signal line, it's to be expected if you get something like we just saw. But here's what I wanted to talk to you about. So here are the daily PMO readings. And what I did is I took pieces out of time and looked at what the daily PMO had been doing during that time before some of these bear market situations. And there were a lot of similarities that I came up with, and we're living through a few of them right now, I think. So what I'm looking for, first of all, I'm going to start on this. What I noticed, and you can see it here during the beginning of this last bear market there in 73 and 74, and right before 1969, we had that drop bear market there. And what I found is, you know, granted, this didn't come up until we'd already made a corrective move, but it came up, and even though the signal may have been, if you want to think about it, a little late because you had to endure this decline. Ultimately, the signal came in and helped you not have to endure that decline in the bear market. So what I found is you have these declining bottoms on the PMO. And when you get that oversold reading, and then you come up and fail with the PMO to cross above that zero line, first time out, when you start to see that, that typically is telling you you're in a bear market. You're getting ready to be in a bear market. And this is a very long-term chart. So we're not seeing all of the little bumps and noisy moves, excuse me, of the PMO in the meantime. So these are major PMO tops and bottoms. And so here's another one, decreasing PMO values, failure at the zero line. But what I wanted to show you is, how do we know when we're done? And how do we know maybe if this correction is done? What I noted is that when you finally were able to see the PMO get into overbought territory, that generally signaled the end of the correction here, the decline, the bear market decline here. That's when we started to see it come out. The other thing I noticed, and now I'm going to move on to, these are the 2000. The dot-com bubble bear market, and then of course the one more recently, that 2008. And look at the similarities here. So again, we had this very difficult correction, right? And then we came up and the PMO managed to get above the zero line and gave us overbought readings. And that tended to be when you saw that big decline over. And that's really, it makes sense because you're having a lot of upward momentum on the PMO. You're seeing it move up despite the decline. And so that does give you a little bit of comfort that maybe this is it. Maybe we're done. So that's what I would be looking for. Now, here is in 2000, there are those declining bottoms on the PMO and then the failure to get above the zero line. And that occurred back up here. Granted, you had to deal with this, but you didn't have to maybe deal with that. We knew it was over. In this case, we ended up with a positive divergence, and that's what ended it. And we started to get the rally. We did still have to endure another correction, but when we got that overbought reading, it was over. And then you have declining bottoms here, failure to get over the zero line, and a similar situation. We finally ended with a positive divergence and a move to overbought territory. Here is where we are currently. There are our declining bottoms. The good news that I could point out is that the last PMO bottom did not end up in oversold extremes. It didn't go below -2. So that could be, maybe not the problem, or not a problem, but we are failing here below that zero line. And I would want to watch that very closely. I'm going to bring this to a live version so we can see what it looks like currently in this moment. You can see the PMO is trying to turn up again, but the main thing is we got that failure. So now I'm going to be watching and seeing where the PMO goes. If we can get it back above zero, and certainly if we can get it into overbought territory, then I think we're more home free. But at this point, to wait for this to end, I would be watching for the overbought reading or to get a major positive divergence where you have the declining bottoms on price and the rising bottoms on the PMO. So that's pretty much my case. I do want to show you very quickly, though, our monthly charts and our weekly charts, just so you can see what happens here. So these are the weekly PMOs. I have marked the sell signals, and you can see what's happened as far as the weekly chart PMOs are concerned. And, you know, typically you're going to have a decline, even in, you know, this coming out of this great bull market run. That sell signal, while it didn't end up in a huge decline, we still had that very volatile timing. It wasn't until we got the buy signal that things started to shape up a little bit. And then I'm going to just go over here to the monthly chart for the S&P, because I think this one I've really marked up for you. This is the monthly chart. Look at what happens when you get monthly PMO sell signals. They don't happen that often, but look at this chart. I think it's pretty clear what you have to worry about. And I think we do have to worry. We're getting that low, you know, those tops are lower here on the PMO, and that bothers me to get a sell signal below the previous top. So anyway, that's it, Tom. That is my plug. I do want to make a case for the fact that tomorrow I am going to start my new show, Decision Point. It will be basically a wrap up of everything that's happened during the week. So it'll look a lot like the Decision Point report segment that we did on Mondays. I'm going to be moving sentiment to Mondays, and I'm going to be doing an expanded version of the Decision Point report. I'll be bringing my dad on occasionally when I can get him. But tomorrow, since the monthly charts will have just gone final, boom, that's what I'm going to be covering as my extra for tomorrow's launch of the Decision Point show.
Okay, and I would suggest everybody check out that Decision Point show. I want to be the first to congratulate you on that. I think that is awesome.
Thank you.
I will say, though, my one rebuttal on the chart that you showed, when I look at any momentum oscillator, I like the crossovers below the center line. Those are the only crossovers I pay attention to. And on the chart that you showed, and we can look at it another day, but the chart that you showed only had 3 centerline crossovers, 1974, 2001, and the 2007 bear market. And those are the ones I think that are most important. But again, back and forth.
Oh, definitely. Let's look at that tomorrow. Oh, actually, tomorrow I won't be here.
I want to thank everybody for being with us today. Please remember to complete the survey as you exit. We'd love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. Be back here tomorrow. Happy trading.
This is a little info demo to show you how to put a solid line or something like that on the top of an indicator that you might already have. When you scroll down here, it was on the SCTR line, but I want an overlay of a horizontal line. And in this case, I can set it up so I put the line at 75.4 on the indicator SCTR, and using the colon symbol and then the word blue, it'll put a blue line up there for me like this. So if you're looking to do overlays, just those simple little tools, but use the colon command to help color it.